You're listening to AI Prism from Seoul Economic Daily.
It's Monday, May 11. I'd like to share some thoughts about retail investors. Right now, everyday investors in Korea are borrowing money at an alarming rate just to chase a stock rally.
Yeah, and at the exact same time, you have the biggest financial giants practically locking their cash in a vault.
Right, exactly. So today we're doing a deep dive into, who is exactly on the wrong side of this massive trade and what it means for your portfolio.
The divergence between the two really is staggering. And to understand this split, you really have to look at the massive wave of FOMO, fear of missing out, that is currently sweeping through Korean retail investors.
Oh yeah, we're seeing a huge resurgence of Bit 2, right? That's the Korean term for loan investing.
Exactly, bit two. And the scale is just wild. We're talking about personal credit line balances at Korea's 5 major banks blowing past 40.5029 trillion won.
Wait, so that's over 28.2 billion US dollars, right?
Yeah, over 28 billion US dollars. And get this, in just 3 days, that balance jumped by 715.2 billion won.
Which is roughly 500 million US dollars in 3 days.
In 3 days. It's an incredible amount of capital moving very quickly. And, well, that speed is exactly what has regulators sweating.
I mean, I want to unpack that a bit because I look at these standard bank credit lines as basically hidden margin loans.
Oh, absolutely. They are.
Because if you borrow from your brokerage to buy stock, the system sees it. The broker will margin call you the second the stock drops too far. But if you borrow from a personal bank credit line to buy equities, the system is flying blind.
Right. Regulators like the Bank of Korea or the Financial Supervisory Service, they just can't see that systemic risk building up until it's too late.
The guardrails just aren't there in the same way.
They aren't. And what makes this retail borrowing binge so precarious right now is that the smart money is actively fleeing the scene.
Yeah.
Like foreign institutions are pulling back hard. Look at EWY, the major South Korea ETF.
Oh, yeah, I saw that. Didn't they just see something like 1.01 billion US dollars in outflows recently?
Yeah, exactly. 1.01 billion US dollars flowing out. So you have retail investors walking into a trap, borrowing to buy, while foreign institutions sell.
And domestic institutional giants are acting weirdly, too. They aren't just selling, they are fiercely guarding the cash they already have. Take Woori Financial.
Oh, the Tongyang Life deal.
Right, they're in the process of acquiring Tongyang Life. But instead of a standard cash buyout for, the 350 to 360 billion won, it would cost roughly 250 to 260 million US dollars. They are jumping through hoops to do a share swap.
Yeah, they are.
And they are simultaneously pumping $1 trillion or 700 million US dollars into their investment arm. But wait, instead of just buying the company outright with cash, they're using stock. Doesn't that water down their shares? Why overcomplicate it?
It sounds counterintuitive, I know. But it is entirely about protecting a vital metric called the CET1 ratio.
Okay, the CET1, that's a bank's core capital ratio, right?
Exactly. Regulators require banks to keep a certain amount of cash in the vault for safety. The CET1 ratio measures that safety buffer.
Okay, but how does a share swap actually help with that?
Well, think of it this way. If Woori spends cash to buy Tongyang Life, their capital reserves drop. If those reserves drop too much, regulators step in.
Oh, and restrict their ability to pay out dividends or do stock buybacks.
You got it. By trading shares instead, the cash stays in the vault. They bypass the restriction, keeping both the regulators and their dividend-hungry investors happy.
Ah, so they keep their dividend capacity intact. Which makes total sense when you look at Korea's Value Up program.
Precisely. Value Up is the government's major push to fix the Korea discount. That chronic undervaluation of Korean stocks compared to global peers.
Right. The core of that program is encouraging companies to boost shareholder returns.
Yeah, so if Woori blows its cash on an acquisition, it can't support the Value Up initiative. So institutions are engineering their deals specifically to hoard cash for shareholders.
That is such a fascinating dynamic. So you have highly leveraged retail investors, blind to the downside on one hand, and highly cautious cash hoarding institutions on the other.
Yep. And both groups are walking straight into a massive macro stress test this week.
It's basically a 4-day gauntlet from May 12th to the 15th.
It really is.
You've got US CPI inflation data dropping, Fed Chair Jerome Powell's term expiring, and a major Trump-Xi summit tackling everything from tariffs to AI.
And right in the middle of that global geopolitical storm, we get a key domestic catalyst. The KDI, Korea's premier government economic think tank, releases its revised growth forecast.
Right, and if the KDI upgrades its outlook, and we get constructive news out of the US-China summit, it could fuel the KOSPI's current rally and bail out those leveraged retail investors.
But if inflation data misses or trade tensions flare up at the summit, the narrative flips instantly.
Which leaves us with a final provocative thought for you to ponder. If things do go south, say those US-China trade talks unexpectedly stumble, we know the stock market takes a hit.
Yeah.
But if all that stealth margin we talked about gets called, it doesn't just crash individual portfolios. If millions of retail investors suddenly default on standard bank credit lines, do we start seeing a localized banking crisis spill into the real economy next?
It's a very real risk to consider.
That's today's AI Prism, Retail Investors. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a One IFRA award-winning series. We'll be back tomorrow.
You've been listening to AI Prism from Seoul Economic Daily.